All right, now we will be discussing the calculation of the temporary difference. Now, it's a simple thing how to calculate the temporary difference. We have already discussed it. That these differences are due to the difference between the accounting profits and the taxable profits. Or simply you can say these are the differences due to the carrying amount. Now, carrying amount is the carrying value which is in your books. So the difference due to the carrying amount and the tax base. Now the tax base is the figure which is calculated for the tax purposes. So the carrying amount is your book value. This is your book value, the value in your own books, which means the value in the financial statements. And the tax base means the value for tax purpose. Like for example, cost minus accumulated depreciation is the carrying value. Cost minus tax depreciation or the capital allowance is the tax base. So remember, if the carrying amount is more than the tax base, this will give rise to the taxable temporary difference. And when the tax base is more than the carrying value, this will give rise to the deductible temporary difference. So if the carrying value is more than the tax base, this is the taxable temporary difference. And if the tax base is more than the carrying value, this will give rise to the deductible temporary difference. Still, it's not the deferred tax asset or liability. You need to multiply it by the tax rate. Like when you get the taxable temporary difference, you multiply it by the tax rate, which is given in the exam question. And then you will get the deferred tax liability. Similarly, when you have the deductible temporary difference, and deductible temporary difference is the case when the tax base is more than the carrying value, and then you multiply it by the tax rate, and you get the deferred tax asset. So I need to tell you one thing, that by looking at this example, which we did in the previous slide, the first example was related to the depreciation. So you see over here, the carrying amount is 80,000, which is cost minus its accumulated depreciation. And the tax base is cost minus its tax depreciation. So you see 80,000 is more than 80,000 is more than its tax base. Carrying value is more than the tax base. So when the carrying value is more than the tax base, this will give rise to the taxable temporary difference. And when you multiply it by the tax rate, you get the deferred tax liability. So 80,000 is more than the tax base. So the difference is the taxable temporary difference. And when you multiply it by the tax rate, you get the deferred tax liability. Over here, the provision is 15,000 negative in your books. Why we are calling it as a negative figure? Because it's an obligation. Provision is an expense and the obligation. So the carrying amount is the carrying amount of the liability. Here we were having the asset, so we took that figure in the positive. So here it's an obligation, it's a liability. We are taking that figure in the negative. So the negative figure, and then we have the zero over here. So this zero is greater than the negative figure. This zero is greater than the negative figure because we know according to the maths rules, zero is greater than negative. So here the tax base is more than the carrying value. So when the tax base is more than the carrying value, this will give rise to the deductible temporary difference. And when you multiply it by the tax rate, you get the deferred tax asset. So you need to remember this thing for the exam, that when you compare the carrying value with the tax base and the carrying value is more than the tax base, this will give rise to the taxable temporary difference. And when you multiply it by the tax rate, you get the deferred tax liability. And when the case is vice versa, that means the tax base is more than the carrying value, then this gives rise to the deductible temporary difference. And when you multiply it by the tax rate, you get the deferred tax asset. So remember this thing for the exam, that we need to do the correct comparison. And then after comparing, we need to see which one is more than which one. So here are the few examples. The first one are related to the assets. So because we may have the carrying amount of the asset, we may have the carrying amount of the liabilities. So let's see few examples in order to see how the taxable or deductible temporary difference are being calculated. The first one is an easy example. You've already seen it. A machine cost $100,000. Depreciation is 18,000. So when you deduct cost and the depreciation, you get the carrying amount, which is 82,000. And then we have the tax base as well. Sorry, the capital allowances as well. And when you deduct the cost from the capital allowance, you get the tax base, which is 70,000. So here we can clearly see that the carrying amount is more than the tax base, and this gives rise to the taxable temporary difference. This is the taxable temporary difference. It's nothing. It's not the deferred tax asset. It's not the deferred tax liability. It's just a temporary difference because the carrying amount over here is more than the tax base. When you multiply it by the tax rate, then you are going to get the deferred tax liability. In the second example, interest receivable in the statement of financial position is 1,000. Interest receivable is an asset, right? Is an asset. So we are showing that figure in the positive. The interest will be taxed when received. So the tax base is nil because the interest income is not accepted unless and until it is being received. So you see here again, the carrying amount is more than the tax base, and this will give rise to the taxable temporary difference. And again, when you multiply it by the percentage, you get the deferred tax liability. And again, applying the same logic. You are recording the income and you were paying the tax on it, but the taxation authority said, no, don't record this income because you have not received it. And they did not collect the tax from you based on that income because they stopped you to record that income. But when the income will be received in the future, you are supposed to pay the tax. So today you have avoided the tax because they didn't accept your income. But in the future, you will be paying the tax because when they accept the income on its receipt. So the future tax consequence is that you will be paying the tax on that income, but now you have avoided the tax. So the future tax consequence should be recorded now as the deferred tax liability. Similarly, we have the examples related to the liabilities as well. Current liabilities include accrued expenses of 1,000. We know the accrued expenses are the expenses which belongs to the current year, but they are not yet being paid. So we have recorded that thing as an expense on the accruals concept, but the taxation authority deals that thing on the cash basis. So they are saying, because you have not paid it yet, so you are not supposed to record it. So you were deducting the expense, and as a result, it was decreasing your profit, but they didn't allow you to deduct the expense. As a result, you're paying more tax now. But in the future, when that expense will be accepted and you will be deducting it from the profit, you will be paying less tax. So the future consequence is you're paying more tax now. And the future, when the expense will be accepted, you will be paying less tax because it will be deducted in the future from the profits. The tax department will allow you to deduct it in the future when you have paid the tax, when you pay the expense. So the future tax consequence is that you will be paying less tax. So today it should be recorded as the deferred tax asset. So how we can see this nil is 0 and this is the negative figure. So here the tax base is more than the carrying amount, which give rise to the deductible temporary difference. And when you multiply it by the tax rate, you get the deferred tax asset. So just simply remember it, that deferred tax is actually the future tax consequence, which you are recording either as the deferred tax liability or the deferred tax asset. Now we have the double entry related to the deferred tax asset. Just remember it for the exam because the examiner may ask you to provide the correct double entry. It may be tested in the form of the objective test case question. So the deferred tax asset, we know the nature of the asset is debit. So when there is a deferred tax asset, you're going to debit it and credit profit or loss. This simply means you're charging that thing as the income. So credit profit or loss, debit deferred tax asset. And remember one thing, that once you have created a deferred tax asset in your statement of financial position, next time you are supposed to see the increase or decrease in the deferred tax asset. Similar is the case with the deferred tax liability, which we are going to discuss in a while. So once you have created the deferred tax asset, you're going to see whether there is an increase or decrease. Now, how we can figure it out, whether we are having an increase in the deferred tax asset or a decrease in the deferred tax asset. Remember, in the exam question, you will be having an opening balance either for the deferred tax asset or for the deferred tax liability. So we have the opening balance. We can see the opening balance, and then we are supposed to compare it with the closing balance. So when we compare opening balance with the closing balance, you can definitely see whether there is an increase or decrease. But regarding this closing balance, this opening balance is clearly given within the question. So there's no need to worry about the opening balance. Regarding this closing balance, there are two things. Either it is given in the exam, that is the best case scenario, you got the closing balance as well. The second thing may be you are supposed to calculate the closing balance. How we can calculate the closing balance? Just multiply the temporary difference with the tax rate. I'm not writing here as a deductible temporary difference because I'm just telling you this works both for the both asset and the liability. If you're having deferred tax asset in the question, just compare opening balance of the deferred tax asset with the closing balance. Closing balance either will be given or you need to calculate it. How we can calculate it? Just see the the deductible temporary difference and multiply it by the tax rate. And if it's a liability thing, you can just take the taxable temporary difference and multiply it by the tax rate. You will get the closing balance. This is the simplest thing. This is the maximum difficulty level you will be having in the exam. Either given, which is the best case scenario, or calculated. And it's not a rocket science. Just take the temporary difference, whether deductible or taxable, and multiply it by the tax rate, and you will get the closing balance. So once you see the increase or decrease, if you figure out there is an increase in the deferred tax asset, then the same double entry would be passed: debit deferred tax asset, credit profit or loss. And if there's decrease in the deferred tax asset, it should be an opposite entry, which is debit profit or loss, which is, you can say, an expense or a reversal of the income, and credit deferred tax asset, decreasing your deferred tax asset which you have recorded in the books. Similar is the case with the deferred tax liability. The nature of the liability is credit. So deferred tax liability, credit, and charging this thing as an expense. So debit profit or loss, credit deferred tax liability. Again, once you have recorded the deferred tax liability, you're supposed to see the increase or decrease in the deferred tax. Now, if there's an increase in the deferred tax liability, so when the liability is increased, the liability should be credit, deferred tax liability credit, debit profit or loss. That means increase in the deferred tax liability should be reported as an expense. So debit expense, credit liability. And when we have the decrease in the deferred tax liability, so the double entry would be credit profit or loss and debit deferred tax liability. So you see, decrease in the liability is usually we call it as the income. Or you can say it's a reduction in the expense. So increase in the deferred tax liability is recorded as an expense. Decrease in the deferred tax liability is, you can say, income or the reduction in the expense. So this is very, very important for the exam. Similarly, when you have the increase in the deferred tax asset, this is recorded as the income. Or when there's decrease, you can simply say it's an expense, or you can say it's a reduction in the income. But the income and expense should be the appropriate term to use over here. Now, this is the double entry chart, which I have already provided to you, increase and decrease. And then this is the presentation, whether we are having deferred tax asset or liability, this should be recorded within the statement of financial position as a non-current asset or a non-current liability. And then we have the current tax provision that is recorded as the current liability. But the deferred tax should be recorded as a non-current asset or the non-current liability. Now, we have another thing related to IAS-12 within F7, which is the specific differences. Although there are many specific differences pertaining to the IAS-12, but in F7, we have just the one major thing, which is the deferred tax consequences on the revaluation of the asset. The specific difference means that the deferred tax consequence on the revaluation of the asset. So remember, we need to compare two things. We have the carrying value compared with the tax base. This is what we are doing since the inception of the IAS-12. The carrying amount will be increased when there is a revaluation. Like when we are talking about the upward revaluation, the carrying value should increase. But the tax base remains static because the taxation authority does not accept this increase in the value of the asset as part of the revaluation. Because obviously when you're doing the revaluation, you're just increasing or decreasing your book values, and there's no inflow and outflow pertaining to that. Because when you're revaluing your asset, no one is making you the payment. It's just a movement in the value of the asset. So the tax base remains static because the taxation authority is not going to accept the revaluation. As a result, the carrying value becomes more than the tax base. And when the carrying value is more than the tax base, this is known as the taxable temporary difference. And when you multiply it by the tax rate, this gives you the deferred tax liability. So we have the deferred tax liability consequence on the revaluation of the property, plant, and equipment. In the exam, the examiner is going to specify. The first scenario may be ignore deferred tax on revaluation. Now, this is the simplest thing to see. It's a good news always to see when they are saying ignore the deferred tax. So there's no need to do the deferred tax calculation on the revaluation because they're saying ignore it. And then they say defer the revaluation gives rise to the deferred tax consequence. Now, in that case, you need to calculate the deferred tax liability on the revaluation. In the first case, when the examiner says ignore deferred tax on revaluation, then simply ignore it. There is no need to calculate the deferred tax on the revaluation. The important thing is that when we do the revaluation, the gains are recorded in the other comprehensive income because we are talking about the upward revaluation right now. So revaluation gains are recorded in the other comprehensive income. So any deferred tax consequence related to that should also be recorded in the other comprehensive income. This is the simplest principle. The gain on the revaluation is recorded in the other comprehensive income. So does its deferred tax consequence. We have an example, and through example, we can easily understand the treatment of the revaluation against the deferred tax. So I've told you that you are supposed to compare the carrying value with the tax base. An entity Dodge owns property, plant, and equipment that cost $100,000 when purchased. Fine, $100,000 is the cost. The cost remains the same for the tax base. The depreciation of 40,000 has been charged up to the reporting date. So you need to deduct 40,000 from it, and then you get the carrying amount, which is, there's no need to write the carrying amount as I already made the heading. So it is going to be 60,000. The entity has claimed total tax allowances of 50,000. So you just deduct 50,000 from here, and then you get the tax base, which is $50,000. It's a dollar, which we are doing. So the carrying amount is 60,000 and the tax base is 50,000. The asset is revalued to $90,000. So that means the carrying amount should be increased to 90,000 and the tax base remains the same, which is 5,000. Sorry, 50,000. This 30,000 is the gain on revaluation. This is the gain on revaluation. Now, the gain on revaluation will give rise to the deferred tax liability. So 30,000 multiplied by the tax rate, which is 30%. So that means 30% into 30,000 into 30%. This is 9,000. This 9,000 is related to it's actually the deferred tax liability, which is related to the revaluation. Other than that, we know the carrying amount is more than the tax base. And how much it is more than the tax base? 40,000. So 40,000 multiplied by 30%, which is the tax rate, because this 40,000 is the taxable temporary difference, because the carrying value is more than the tax base. And the deferred tax liability is 12,000. Now, out of this 12,000, 9,000 is the liability, which is related to the deferred tax on revaluation. So how we are going to record it? As I said, that you are going to treat it in the other comprehensive income. The gain is recorded in the other comprehensive income. So does its deferred tax consequence. So 9,000 is the deferred tax liability, which is related to the revaluation. So you're going to deduct it from the other comprehensive income. The total deferred tax liability is 12,000. We have already calculated it. So the balancing figure goes to the profit or loss, which is 3,000. And you see in the revaluation surplus, we will be having 30,000, the gain minus its deferred tax consequence. So it is going to be 21,000. So the point to remember is that the gain on the revaluation is treated in the other comprehensive income. So does its deferred tax consequence. So in the exam, you just simply need to do this thing. Take the gain on the revaluation, multiply it by the tax rate. You get the deferred tax liability on revaluation. And just treat it accordingly. So this is the standard working. If you understand these formats, then the exam question is going to be a piece of cake for you guys. And these formats are based on all the concepts which we have studied till now in this IAS-12. The first thing is the extract of the statement of profit or loss. In the statement of the profit or loss, we will be having the tax expense. Mostly we'll be having the tax expense. In some cases, we may have the reversal of expense or the reduction in the expense. Sometimes we have the tax refund, but these are the rare scenarios. Most of the times, you are supposed to make the payment to the taxation authority, which is your current tax provision. This year-end estimate, remember this thing, the term estimate is important. This year-end estimate is the current year tax provision, which we have already discussed many times. Current year tax provision. This is the estimated tax for the year you are talking about within the question. So this is a current liability. If it's a tax estimate, if it's a tax refund, it's a current asset. Then you have the under provision. If you see the debit balance in the trial balance, this represents under provision. Under provision increases your tax charge. That is why you see we are adding it in the current year expense. If you are having a credit balance within the trial balance, this represents an over provision. An over provision reduces the current year tax charge. That is why we are deducting it. And then we have the increase or decrease in the deferred tax liability. And similarly, we can have the increase in or decrease in the deferred tax asset as well. But why I have written out the liability only because in all of the question till now, examiner asks you to calculate the deferred tax liability. The deferred tax asset may be a rare scenario, but you already know how the increase or decrease works. So increase in the deferred tax liability, we have already discussed, is recorded as an expense. And decrease in the deferred tax liability is income or the reduction in the expense. So if you have increase in the deferred tax liability, that represents an expense. That is why these all three are being added. And decrease in the deferred tax liability is going to be a negative figure because this is the reduction in the expense or the income. And if you take the net figure, this net figure will be recorded in the statement of profit or loss as the income tax expense. Now, this increase or decrease in the deferred tax liability is the separate working, which is a simple working. So you just see the closing balance. I told you that the closing balance either will be given in the exam question. If it's not given, then you just take temporary difference into tax rate and you get the closing balance. The opening balance is always given in the question. And this is the revaluation of property. This is the deferred tax on revaluation. So deduct the deferred tax on revaluation from the closing balance. And then whatever balance you get, you just compare it with the opening balance and you will get the increase or decrease in the deferred tax liability. So what we are simply doing, we are taking the closing balance of deferred tax liability less deferred tax on revaluation, because the closing balance liability already includes a deferred tax. So it is going to be a double thing if you are not deducting it. Then you get this balance, you compare it with the opening balance of the deferred tax liability, and you can figure out increase or decrease. Increase represents an expense, decrease represents a reduction in the expense. This is all about IAS-12, nothing else. Simplest working, easy and absolute marks in the exam. You just need to make sure you are understanding these formats. Let me just revise it. First of all, we are starting with the extracts of the statement of profit or loss, because in the exam, the examiner mainly asks you to calculate the income tax expense. So the income tax expense is calculated as, first of all, take the year-end estimate. This is the current year tax provision, which is also a current liability. Under provision is the debit balance in the trial balance, which increases the tax charge. Over provision is a credit balance, which decreases the tax charge. Increase in the deferred tax liability is an expense, which is being added in the other expenses. So you can see all three are being added. Decrease represents a reduction. You are going to reduce it. This net figure belongs to the statement of profit or loss. This is the tax expense. So in the statement of profit or loss, you are going to take the tax expense. And that tax expense is deducted because expense are always deducted in the statement of profit or loss. In the statement of financial position, we have two things. We have the current liability and the non-current liability. The current liability is the current year tax provision, which is the current year tax estimate. In the non-current liability, you're supposed to take the closing deferred tax liability, which you are being given, or you are calculating it by multiplying the temporary difference with the tax rate. This is all about IAS 12.